Good morning. Today is Wednesday, November 11th, and thank you for joining us for another edition of the Market Commentators podcast. My name is Jake Wilms, and I'm a quantitative analyst with the Milwaukee Company, and today, joining me this morning is Mike Wilms, the Milwaukee Company's Chief Operating and Compliance Officer, and Andy Wilms, our CEO and President. Good morning, guys.
Morning, Jake. Good morning, Andy.
Good morning, Mike.
How are you guys doing this morning?
All's well.
Doing great, thanks.
That's good. Like to hear that. Just a quick reminder that nothing that you hear in this podcast should be construed as investment advice, and the views expressed by Mike, Andy, and myself are not of those of the Milwaukee Company. So why don't we begin as usual with a market recap by Andy.
Okay, well, let's talk about what happened last week first, just to bring everybody up to date. It was a great week on Wall Street. It was the S&P, Dow Jones, and NASDAQ composite indexes best weekly gain since the end of April, or since beginning of April, excuse me. And for the S&P 500, it was also the best election week results since 1932. So that's going back quite a ways. It seems like most people thought that the stock market rally was primarily attributed to the fact that it looked like split government was going to be the result of the election, and in which the Democrats will control the presidency and the House, and the Republicans will continue to hold a Senate majority. It wasn't good news for the U.S. Treasuries, on the other hand. They continued their recent struggles last week with the iShares 7 to 10 year Treasury bond ETF edging up just less than 0.5%. But it was its first weekly gain in the past three, so I guess a little something's better than nothing. As far as this week goes, the Dow Jones Industrial Average has soared and bond yields have risen sharply following Monday's news that a coronavirus vaccine had been developed by Pfizer and had a 90 plus effective rate, and that in its phase 3 study, which included over 45,500 volunteers. So this was a really big group with results that far exceeded what anybody had been expecting.
Yeah, I can't wait. I definitely want to touch more on that. Very exciting for a vaccine development for sure.
Yeah, absolutely. And then yesterday, traders continue to rotate out of the so-called high-flying stay-at-home tech stocks and increase their exposure to the better established companies such as Boeing and Chevron and Citigroup and General Electric, those companies that really dominate the Dow. And so what we've seen is that we've been seeing a lot of rotation out of the NASDAQ into Dow and other more stable companies, or long-standing companies. The Dow's, as of this week, at the time of this discussion on Wednesday morning, the Dow's up 3.87%. The S&P's up a little over 1%, and the NASDAQ, who has been the darling on Wall Street, is now down almost 2.9% for the week.
Isn't that interesting, though, about the NASDAQ? Do you think it has anything to do with the announcement of the vaccine?
Oh, I think it's directly tied to that. The idea being that the vaccine will mean that we probably will get through this whole COVID situation, notwithstanding how difficult things are right now. We probably will get through this in the next year or so. And as a result, a lot of these companies that have been profiting from people working from home will find it will suffer a little bit. And as the economy normalizes, some of the traditional big cap companies will start to do better.
Thank you for that update. Mike, how about you fill us in on the economic front?
On the economic front, just to stay away from inundating everyone with statistics, just a key couple of numbers here. On Friday, the October employment report came out, and the unemployment rate dropped to 6.9%, which was a much better number than the 7.3% that was expected. And interestingly, the Bureau of Labor Statistics came out with a new set of numbers, and the current number of job openings is now back up to a record high of 6.3 million job openings. So there's currently supposedly more people or more job openings than there are people looking for work. I'm having a hard time reconciling those numbers, but those were the numbers as reported. And I thought it was interesting with Andy talking about Treasury rates and what's happened there with some of the Treasury-related ETFs. The 10-year auction yesterday was the largest 10-year auction in history at $41 billion. And the auction did not go very well. There's two types of bidders: direct bidders through the primary dealers, the 26 large investment banks that buy the Treasury securities on behalf of their clients directly from the Treasury, and then indirect bidders that come through. Normally the indirect bidders are foreign central banks. The indirect bidder percentage was 13%. Historically, it's been north of 14, and the auction really struggled where it was priced at 96 basis points when the 10-year had been trading at just under 95 basis points at the time of the auction. So I think the market is starting to become a little wary relative to the size of the auctions and the number of securities that are being sold by the Treasury. So that's something that we definitely should continue to watch.
It seems that the concerns that we've talked about the last several weeks about interest rates rising and the dollar falling are starting to materialize here in a pretty significant way.
Your observations previously have been spot on, Andy.
Well,
it pains me to have to say that, but
the other thing to keep in mind too is as the coronavirus seems to fade and we have our situation return back to more normal market conditions, things are going to change with respect to how our markets have been behaving the last 6-7 months. So I've been expecting something like we've been talking about for a while now, but we just have to wait for a big kickoff from this COVID front, because that's been the leading driver of everything in the economy for forever.
Well, I don't think it's fading, Jake. I don't think the COVID's role is fading at all. I think just the opposite. We've reached a stage where it's worse than ever.
Well, yeah, let me be careful of my words. Fading as though we have to wait for this vaccine to really kick off before we will see anything fading. I got a bunch of scary statistics on COVID this year, unfortunately, because we are continuing to rise in the US. We've reached over 10 million cases total in our country. We're definitely averaging over 100,000 cases a day. And we're even seeing quite the big spike the last 2 weeks, over like a 23% increase in average cases from 2 weeks ago. If you look at graphs, they just show big spikes in November and mid-October. But more specifically this week, I want to talk about Wisconsin, because Wisconsin is actually one of the top 5 highest risk states in the US for COVID. It has a 45% increase in their 2-week trend. And per 100,000, they have 105 cases of COVID, and they're averaging over 6,000 new cases a day.
It all depends on how the public responds to, dealing with it. And so far here in Wisconsin, there's been a lot of skepticism about the benefits of wearing masks and that sort of, and social distancing, and that skepticism has been reflected in the number of cases, I think.
Yeah, I think that's totally true and spot on. It's difficult I'm sure, to cooperate with a very extended, long effort to contain the virus. But I'm going to be honest, looking at these states that are the highest risk, we're looking at North Dakota, South Dakota, Iowa, Wyoming, Wisconsin, a lot of these states that are Midwest and maybe not quite the same sort of ideal set as something on the coast, as like a California.
Well, I mean, numbers that came out this morning here, I think we were over 120,000 cases in the U.S. yesterday.
Right. Yeah.
And at this point, there are 62,000 or just under 62,000 people hospitalized relative to having the virus. If the entire 62,000 were in ICU units, the scary part is that there's only approximately, well, just under 100,000 ICU beds in the entire country. So we're going to really need to start paying attention to what we can do to reduce the infection rate.
Yeah, I think that's really important, especially in these closing couple months as the vaccine developments reach their final stages and get prepared for distribution. We want to make sure we're not quitting early and throwing in the towel on our good behavior and preventative measures before we should be. But speaking of the vaccine, I do want to touch on some important topics on that. This 90% effective for this vaccine puts, if this is what would hold and the expected success rate for people to be absorbing any symptoms of COVID after taking the vaccine, this would be an extremely effective vaccine. It would be on par with popular vaccines such as the measles, would be more effective than your common flu vaccine. This number, again, as we heard from Andy earlier, it's from a sample of about 45,000 participants, and just over 90 developed symptoms.
And let's focus on that for just a second, Jake, if we can. The 90 plus patients that develop symptoms, the way that the FDA had written the clinical trial procedure was initially, once 32 patients had developed symptoms, they would start to collate all of the information and be in a position to report who had received the vaccine, who had not experienced any symptoms, and who had. That number was in negotiation with the FDA. The FDA and Pfizer agreed to increase the number to 62. And by the time they got to the 62, there actually were 92 patients that developed symptoms, and that allowed them to review a larger portion of the 45,000 patients that had been in the trial. So it's really pretty amazing that there was 45,000 people in the trial and only 92 patients developed any symptoms after having received the vaccine.
Now, also, it will be sort of half of that because half of the people that participated did get a placebo. So it's not that 45,000 people received it. So that's why some of these things can be kind of confusing because there's very important details in these. Now, something that's more positive, though, is experts are expecting that this would be better than 90% effective at preventing the serious side effects of the virus, because this cutoff isn't just for like life-threatening or ICU responses to the COVID virus. We're talking any symptoms. So if this vaccine holds at this kind of level, we'd be seeing a much better response than 90% at preventing the scary side effects that people are worried about.
Well, all in all, the initial results are incredibly promising, and let's all be hopeful that get the vaccine into mass production and available to everyone.
All right, let's switch gears to our usual roundtable discussion. So, Andy, what did you have for us to talk about?
Well, I thought it'd be interesting to speak a little bit about how the market might respond to, last week we talked about how the market might respond to different election outcomes. Now that we think we know the result, but maybe we could kind of focus more about what it actually will likely mean for the stock market and the economy as a whole going forward. I think there's I think there's some real good lessons that can be learned from what's transpired. I mean, this has been a very unique instance in history, and seeing how the market responds provides us some good opportunities to increase our ability as investors. And the first and foremost thing that comes to mind is how we once again see how difficult it is to time the stock market. Last week's rally, notwithstanding resurgence of COVID-19, the uncertainty surrounding the president election outcome, and talks of litigation to resolve it, and the control of the Senate being still in debate, and yet the market still went up. And if you would have done all those things in advance, there's no way you would have predicted the market goes up. So it once again demonstrates that it takes a lot more than just clairvoyance. Even if you're clairvoyant, you'd have a very hard time predicting what the stock market's going to do in the short term. The second is that it reminds me that unexpected events such as this Pfizer announcement we were talking about can make sound investment decisions look bad and bad investment decisions look good. And what I mean by that is if you were overweight stocks that last week for some unrelated reason, you're still going to feel smart now because the market's gone up so much. And if you were underweight stocks for a very sound reason, like you wanted to take some risk off the table, you're going to feel pretty bad about it, even though your decision was probably the right one. Or at least very sound decision. That way. So we got to remember how much, it's very important for investors to remember how events that you cannot predict can have such a major impact on market performance, and not to evaluate our own performance based on these so-called black swan events. And that kind of leads me to what my third takeaway would be: is important to keeping your investment goals in mind when the market moves away from you. I've had conversations with clients who have been underweight stocks because they were concerned about preserving wealth more than maximizing return. And the thing that I encourage them to continue is that the decision to underweight equities to preserve wealth in a high-risk environment is a sound decision that's consistent with their long-term investment goals. And the fact that the market has rallied here doesn't affect the soundness of that decision. And the last one I'll mention for now is just the importance of keeping to your investment plan when the unexpected occurs. Just because the market's rallied here in the last couple of weeks doesn't mean you should change your investment plan and take on more risk, or the fact that we've dealt with market drawdowns back in March doesn't mean you should change your investment objectives there. So you have to stick with your investment plan and your investment approach. And in order to do that, it's very important that you have confidence in both the strategies that you're using and the investment advisor that's helping you if you're working with one.
I think those are some great points, especially with your second point about how you can unexpected events can make sound investments look bad. So especially with what's going on with all we've been talking about today with the virus and last week with the election, it really has been an interesting couple months here where a lot of different unexpected events have been chirping up here and there, and maybe some people have made some poor decisions that have benefited from them, but needless to say, that's no reason to try to differ from what your plan has been for a long-term safe investment horizon. So I totally agree with you on that.
No, and I think if you go back here, it might be 20, 30 years, but one of the original Vanguard marketing slogans was staying the course. And I think that's exactly what you're talking about. I think Andy's made the key points. If you look at the surprises just in the last 10 days with the election and the developments on the vaccine front, and then factor in the unfortunate rise in the virus cases, the old trading cliche always was that the market's going to do exactly what causes the most pain. And where there had been so much hedging around the outcomes with the election and the virus, the spike on Monday, I would imagine, caused a fair amount of pain, and the margin clerks were pretty busy at the various brokerage firms with what happened in the market.
How do you think that's going to change over the next week or so?
Well, I don't think we want to be thinking in terms of the next week or so, but I will share with you that one of the large New York firms came out with a pretty aggressive target of 4,300 for the S&P 500 by the end of 2021 this morning. So I think longer term, people are confident that there will be progress on the vaccine front. that there'll be a divided government in terms of the Republicans holding the Senate, where some of the concerns about a blue wave won't materialize. And to this point, earnings for the third quarter have been very positive. And it's looking like 2021 is setting up to be a pretty good year.
Sounds like to me, you guys, our wrap-up saying should be stay the course and wear a mask.
Exactly. Everybody needs to be vigilant and practicing the social distancing and wearing a mask, and everybody needs to be safe.
Yeah, couldn't agree with more. I think that wraps up our time, though. So thank you, gentlemen, for joining me on this podcast. As usual, appreciate your time and your thoughts.
And before we go, I'd like to thank anyone listening that's a veteran, given today is Veterans Day.
Oh, fantastic. Thank you. And thank you to all veterans.
Yeah, absolutely.
Please keep in mind that you should not act on anything you have heard in this podcast until you have discussed it with a qualified financial professional who is familiar with your personal situation and investment objectives. And on that, I'll wrap it up. Thank you all for joining. Have a great rest of your day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast